Hello everyone and welcome to what is our first but not last webinar on alternatives in upstream oil and gas. For those that do not know me, my name is Phillip Dunning. I work on our corporate strategy team, mostly on acquisitions and integrations. I tend to do some of our more forward-thinking webinars as my background is in finance and upstream oil and gas. Some of you may have joined in on our 5-part mineral series we just finished, where we're looking at the cross-section of alternatives as it relates to minerals space. If not, the webinars are always on demand. Now, today I'll be joined by Nick Volkmer and Oma Wilkie from our intelligence team. Let's get started. General disclosures and our agenda. Today we'll be taking a look at alternatives in the upstream oil and gas space. This will be more of a 10,000 foot view to try to look at how current oil and gas skills can be applied to alternatives. As we've discussed with many groups on understanding of the basic of alternatives, most recently within that 5-part webinar series for minerals, upstream oil and gas is primed to evaluate the basics of alternatives using our inherent skills. So we'll take a brief look at history, discuss the life cycle differences, the idea of controlling the narrative, and how we can view alternatives against an acreage position, and then turn it over to the intelligence team for their views on alternatives from a few of the reports that we've published and some of the product initiatives that we're looking at putting out. Like many webinars, this is not meant to be exhaustive, but drive a conversation forward with you, our clients, as the idea of energy creation and consumption is an ever-changing study. And over the past few decades, the energy landscape has changed dramatically as oil and gas has moved from being the main source of energy for consumption to the main energy source for power generation. And as this has changed, obviously we've entered into kind of this new phase where it competes with other energy creation sources, specifically alternatives. So what's different with 2020 and why are alternatives feeling like they're being pushed more and more? Well, in reality, they've been around for a while. Texas has benefited greatly over the years from lower energy costs compared to other states without other sources of energy creation. So some states, like the island of Maui, run completely on alternative energy. In reality, that is the story of alternatives. Power generation more than replacement. And power generation is an ever-changing industry. Coal to natural gas power plants, alternatives as supplemental energy, etc. And understanding that for a reliable grid, energy must be on demand at all times. Alternatives at this second cannot give enough comfort to not create supply-demand issues as it relates to power generation. So let's remember that the idea of alternative energy does not mean non-carbon using. There has long been an argument that alternatives are non-carbon producing energy. However, there's a lot of carbon produced in making the turbines for wind farms, solar panels for solar farms, from mining, designing, construction, even the starting of a turbine spinning all require oil and gas and byproducts. Developed countries have also been the main drivers of alternatives due to the ability to finance the projects. Even as countries like the U.S. have reduced our carbon footprint, non-developed countries are increasing their use of carbon-based energy. Why? It's the cheapest energy to burn for fuel. As countries such as China, India, and others continue to grow, carbon-based energy will be their main source of fuel needed. Even within the U.S., oil and gas is still cheaper than its alternative counterparts. And it's also an instant on-demand energy source, which is needed for a reliable grid. So the shift from an oil and gas company to an energy company has also helped propel the discussion forward. So many large integrated E&Ps or super majors have announced their plans to further spend money on alternative projects. Profits will still be from oil and gas, but they're dipping their toes back into the alternative world. For some, this is their second go around at trying to make alternatives work as part of their portfolio of energy. Now, this makes sense if you take a step back. These companies are vertically integrated from upstream, midstream, downstream, even end-user distribution. So there's really no reason other than lower project returns today to not be investing in them from their corporate standpoint. From the large independent view, it might make sense to utilize some of the non-used acreage for alternatives. It doesn't mean that they'll be operating them, but rather using their land position to monetize the acreage. Think about an E&P that has surface rights to tens of thousands of acres. Pads will only take up so much of that space, and they could farm out the rest to an alternative company, taking upfront payment and royalties. There's no reason why they shouldn't monetize it. For others, the ability to put in alternative energy near large facilities can help offset costs. If you put in wind power generation, you can supplement X% of your operating costs, your electric costs. Why not? Electric is expensive to run pumps, and as the fields age, there will be an increased need for EOR through pumps, gas lift, etc., all which have the potential to save money using alternatives. Over time, there's also the inherent thought of, the basic disruption theory, so minnow and shark. As consolidation occurs inside the upstream space, large companies become larger. As they grow, they will need to grow their revenue and will start to focus on long-term value. This makes them change their mindset into more of like a super major with more vertically aligned business practices. This means that alternatives come into view to keep the company growing, i.e. a large independent today can become larger over time, which can project them into thinking about becoming more of a rounded energy company. This means that there will be an opportunity at the other end of the spectrum to exploit the upstream assets like we did at the start of the shale boom. Smaller firms will be more nimble and take risks to help find new fields and methods to extract oil and gas, as long as the demand exists, and drive another wave of drilling activity. Last, the idea of the narrative. Anyone reading the news knows about the constant attacks against oil and gas, from frack bans to protests. Upstream oil and gas hasn't really had an easy time. And in reality, when you take a step back, oil and gas, is needed for the world to grow. We're still the cheapest form of energy in the world. And, in order for less developed countries to grow and prosper, they need cheap energy. Even within the U.S., cheap energy is needed to keep the cost of living down, which drives innovation. Think of the cost of, that like a simple server farm has. One idea that many might not realize is what we would call Enverus' purpose that we have as a corporate company, which is to fuel the global quality of life. Why? Everyone should have the right to a better life. It might not be today or tomorrow, but one thing is for sure is that without cheap and reliable energy, wealth cannot prosper within inside of a country. So one thing that oil and gas has done for the world is help fuel new wealth within nations, which in turn raises the quality of life for a country. Not all countries have oil and gas to exploit inside of a cheap manner. The U.S. does. That's why oil and gas inside the United States is so important. Yes, it helps propel the U.S. forward in terms of our own country's wealth, but it also helps, raise others out of poverty. And what more noble cause is that? So even though we're talking about alternatives from oil and gas today, let's not forget the importance of what we do every day and try to get that narrative out to the world. All right, so enough of soapbox talk. Let's talk about the similarities and try to piece together a basic understanding of the realities between alternatives and the upstream world that we live in. So oil and gas is a constructive process, like building a house or any other project. It follows a logical set of steps. Alternatives are no different. The regulatory forms may change, but the general process is the same. Some even have some overlaps. The first one we'll take a look at is viability. Now, viability is Pandora's box. You can look at it at a high level, like oil in place, or you can spend weeks or even months trying to figure out to the smallest piece of acreage, what will this unit produce? The same is true for alternatives. You can't just stick a wind farm everywhere, nor a solar panel. The basis for wind is wind speed at the level of the turbine. Now, you will have to look at population, cities, government restrictions, soil quality, wind patterns, etc. to know if something can actually be put. But the basis of can the turbine even go here is step one. I think for operators, just knowing which parts of their acreage have risk of alternatives is a good enough start. It at least allows for you to map out what areas you might have problems with for future operations and try to get ahead of it. Leases, very straightforward. Like a pipeline or transmission lines, right away and leases have to be taken. The leases are filed at the courthouse, and you can even take a look at them within Enverus today in parts of Texas to determine where some of these are being taken. And we're going to look at that in a little bit with a screenshot. Like oil and gas, many leases are taken out by third parties, so trying to lease a project is a function of lease density. A snake is more of a pipeline, if you think about it in terms of when they pop up on the map. A blob is something else, more like a wind farm. Many upstream and mineral shops are prime to be able to shore up their core acreage positions, ensuring that they have the right-of-way and the surface rights secured. And by locking this up, you can reduce the risk to your operations and increase the potential for future monetization of the assets you have today. Permits. The real difference here is fed versus state, but nonetheless, a permit is a permit. Now, just like oil and gas, there are multiple permits you can track. There's heavy load permits on roads, infrastructure permits, etc. We are thinking of turbine permits versus wellhead permits. Both tell you the same exact thing, your 5 W's, who, what, where, when, and why. In most states, since the surface right-of-way is not interfering with the subsurface with an asterisk, the operator is only notified if it affects a current operating surface location, pipeline, etc. This can leave some operators open to risk of having a company file permits to emplace wind turbines without you actually knowing until the permit is approved and construction is about to begin. And this can disrupt your operations, and so it's best to be tracking these permits in the same way you do oil and gas. Always back to the original principle, know thy neighbors. Construction. Drilling and completion in the oil and gas world, it is, just as a well has to be drilled, an alternative project has to be constructed. Pads for both have to be constructed, equipment on site, etc. Both require hundreds of trucks and logistical nightmares of planning. Infrastructure. While oil and gas has to build gathering lines that ties into your main pipelines, alternatives have to build transmission lines from the power source to a central gathering point and then go into the main grid. These lines can be buried or above ground until they get to the central collection facility. And these lines can either create issues for oil and gas, as you would have to plan around them in the subsurface, for either a pipe or a well. Now, federally regulated infrastructure can be found pretty easily, much like your main oil and gas pipeline maps inside the U.S. And then the last is operations. While we tend to wells, alternatives have a constant maintenance as well. Everything from access roads to turbines to gathering lines needed to get electric to the grid. Many out of oil and gas service worker jobs has started to make a shift to other projects. And we can see this with the recent additional push of job postings from companies like RigUp, who are looking for skilled labor for multiple alternative projects. And we have to be careful not to lose skilled labor, as they are the ones to keep wells producing and are in short supply inside the modern era. The other thing is that field ticking, royalty payments, etc. all have to be conducted inside both worlds, both of which already exist inside the Enverus ecosystem under our business automation group. All right, so within the alternative spectrum, so as an investor, you can really take one of two stances as I've always looked at it, and some try to be inside the middle. You can either be reactive or proactive, and each one has their place inside the market. If you're trying to get ahead or to be proactive, you'll want to focus on potential. Where can activity take place? On the other end, you can be more reactive, which is where are assets today, what is for sale, what is transacting. Luckily, through Enverus, some of this data is already available. The market research database already tracks events for PE funding, the PE funds themselves, and transactions within the alternative space. You can start your research there on what has already taken place and who else is already inside the space. Corporate initiatives. So aligning corporate goals and data is a common practice to ensure what we build matters to our clients. So understanding that most companies want to track what is going on around them and having the opportunity to de-risk the disruption of activity around their planned action is key. Ensuring the data we compile and available for workflows to meet these corporate goals is extremely important. There's always a few hidden goals, though, that are more of an ideal than something we can actually measure. And the idea of controlling the narrative is hard to put numbers to, but it's very easy to discuss and understand. So with controlling the narrative, operators want to obviously control it because they will have an advantage of getting ahead of projects. The main buckets to control are EHG, project control, and monetization. And by understanding where there is potential, shoring up leasehold, using right-of-way, surface already owned, they can even go out and permit a project themselves and sell it off. By getting ahead of a project being permitted around them, they control their field and pad planning. Instead of being reactionary, you can be proactive. Instead of planning your future oil and gas activities around others, you can force the plan to revolve around you. And at the end of the day, everything has a monetary value and perception value. So showing good faith and working with alternatives while ensuring a road to success for your current operations is prudent management. So don't be disrupted. disrupt is what we would say. Now, this is very similar to disposal wells, right? In the sense that you can go out, you can get your 40 acres, you can get the permit, and then you can just sell it off to another group to go ahead and do the activity and to operate it. The same exact thing can be done with alternative projects. All right, so how could this look? So this is not a demo of current product. This is using some of the data sources that we are ingesting to show how some of the concepts we just discussed look in comparison to acreage and wells producing today. Potential. So using global wind speed maps, we can look at how much of our acreage position may be able to produce alternatives. This is not taking into account people, places, and things, but is a good general risk meter. So in this example, this acreage position is almost 100% at risk for wind energy potential. There are current producing wells and lots of undrilled acreage, i.e. it doesn't look like a priority to the company today, but maybe they can monetize it and farm it out in order to at least make some additional money off this asset that already exists today. All right, so activity tracking with legal filings. So leases filings are always an early indicator of what's about to happen. So the green and red on this map are wells producing inside the Permian, and I also put current rigs up there. The other colors are courthouse symbols of wind projects. Notice where some of these projects are taking place compared to oil and gas activity. Do you see any risk? You can log in today and look at this data and start to understand the impact as an operator, specifically inside places like Texas and New Mexico. Permits. So permits are the next stage. So we can look at oil and gas wells, which are in blue and red, versus permitted wind farms, which are in white. And we can see which basins in the west are at risk. Notice that most are not in heavy oil and gas spaces unless you're in Oklahoma. A lot of the wind farms are kind of out, panhandle, quite away from oil and gas activity, except inside that core Oklahoma region. Permits do not have to be disclosed to an operator in Oklahoma until 6 months prior to construction. You do not know what's going on around you. You may not understand its disruption until it's too late and the land is locked up and permits are already approved. The next step is understanding where these turbines even are today. This is kind of the start of what we would call reactive data. The first few were proactive, potential, filings, and permits. Notice which basins or oil and gas locations may be at most risk for wind specifically. Most of it flows through West Texas and Oklahoma, but North Dakota even has some as well. The ice and the cold weather may prevent large-scale farms, but nonetheless they are up there. Wyoming and Weld County in Colorado is another where we're starting to see more pop up. So if we layer this on with our own permits and filings, you can start to get a real picture of the risk alternatives have to your position or your portcos, and how to start controlling your own narrative inside the space when you start thinking about the intersection of the two. The last thing is transmission lines. On the map, the red is currently producing wells, black is permits, and yellow are current producing turbines. The green and blue lines that you see are the transmission lines coming from the government. Since you have to get electricity to the grid, being within range of a line is important to lower your construction costs, but it's not a limitation. So notice the permitted farms compared to producing. They're right inside the stack scoop. The reality is that in some basins, the encroachment will continue as these projects are funded. While not all of these are heavily drilled today, they will limit the potential to be drilled tomorrow. And this is the risk. 10 years down the road, wind farms are forever. They're not going to be leaving. So if we combine everything into one map for Texas and Oklahoma, here's what we get. Current producing turbines in green, permits in white, transmission lines in pink, and wells are the other colors on the map. This is alternatives at its basic, our 5 Ws. And hopefully this has helped shed some of the light on how you can use Enverus today to better understand what is going on around you and be better prepared for the risk on your acreage. For those of you sponsoring or looking into alternatives, understanding that your oil and gas counterparts are primed to help in these projects get off the ground. Leasing for alternatives or oil and gas is a ground game. The same companies can be used to get the lease, and for mineral buyers, buying right away can be cheaper than minerals in some instances. Much like getting ahead of the bit, you can determine where a wind farm may take place and get ahead of the initial lease. The real difference is the project itself, the coordination and construction. The method in which we get there is no different, understanding potential, filing, permits, current producing offsets, and infrastructure. One last thing that we mentioned earlier, for those of you with market research, you can find out about alternatives within the PE database or the M&A database. Now, I'm going to be handing off this webinar to our intelligence team to discuss some of their reports on alternatives and some of the project initiatives that we're doing. I appreciate you all staying with me through the first part of this, and reach out if you have any questions. Intelligence team, take it away.
Thanks, Philip, for a good kickoff and overview of the state of affairs with alternatives alongside oil and gas. I'm Oma Wilkie, and I'm joined by Nick Volkmer. We both sit on the intelligence team, and we're involved in the development and build out of Enverus' renewable analytics. Now, Philip helped frame the structure of analyzing renewables with oil and gas as the foundation. And we think that's extremely important, as there is naturally a lot of large overlap between the skill sets required to succeed in both of those business models. And so today, we're going to focus on some of our recent research from the intelligence team and the roadmap of how we're putting these workflows and others into our Prism platform, just so clients can do these things themselves. What we'll do in this portion of the discussion is extend that idea of the interplay between oil and gas and alternatives, but also evaluate renewables on a standalone basis, so both of these investments can be assessed in their own light or side to side. And ultimately, what we're planning on building will be a platform that allows energy at large to be analyzed, agnostic of source. But I'll leave Nick to get into more of those nitty-gritty details of how that's getting expressed in our platform. So let's extend this analogy of oil and gas and renewables side by side. Now, as many of you know, we've cut our teeth solving the deepest analytical problems in oil and gas, and we'll continue to push the envelope in terms of what clean data and predictive and prescriptive analytics can do for us in the oil and gas sector. Now, fortunately, subsurface complexity and volatile input data, all alongside the surface challenges that Philip had outlined earlier, equip us with the analytical rigor required to tackle the challenges associated with optimizing renewable developments. So I think a good place to start is to dig into a little bit of high level and more macro data. So what we're looking at here is the IEA data showing global spend across different energy sectors. And what immediately stands out is the parity you see between upstream and renewable power. Now, of course, we are in an unprecedented macro environment this year, and so it's not surprising that oil and gas spend has contracted quite materially. And it would be reasonable to expect that to rebound in a more normalized environment. But that said, the political and social tailwinds for renewables are real. And in that lens, it would be prudent to expect that CapEx to grow as well. And so the net effect is that energy investment dollars are poised to expand. And that's why it's so important to understand the spectrum of energy on an apples to apples basis. And with that, I think it makes sense to start highlighting some of our analysis. And we'll begin with BP's recent entry into offshore wind via partnership with Equinor, because it really is symbolic of the expanding universe of energy investment decisions and the importance of having good analytics to make the best decisions. So this deal came with a pretty large price tag of about $1.1 billion, and that's pretty material even for a super major. And we actually published a report assessing this transaction. And this is one of the charts from the analysis. Now, dollar per acre is an unconventional metric, but in the spirit of apples to apples comparison, we wanted to show what the implied dollar per acre was compared to a universe of Permian undeveloped acreage. The power of this is that both of these swaths of geography are viewed as de-risked. The resource is there, it's really just a question of harnessing it. And evidently, as BP views it, they believe both choices are heads up. We've also included prior transactions in the North Atlantic wind region. And so you can see that BP is a step change higher than his. Change is what makes this so interesting. It feels a lot like rising acreage multiples in shale just a few years ago. So certainly a lot to do and a lot to understand as this space continues to evolve. Now, again, on that theme of how do I make informed decisions about investments in renewables, we're showing here our economic model of a potential development in this North Atlantic wind regime, right around the area that BP has stepped into. Now, it's important to note that this is strictly power revenue and it doesn't include all manner of tax credits or capacity payments. What we're really trying to do here is just look at organic. And what we're trying to answer here is what do you have to assume to rationalize the 10K an acre, or more properly stated, the $5 million per megawatt price tag that BP paid? Because that's the decision point that's going to matter in new investments and new entrants thinking about stepping into this space. Now, to us, it seems a touch aggressive, but again, recall this is all organic value. And so even if we can't get to a $5 million per megawatt price on organic value, some of those other things like the tax credits and capacity payments could perhaps get you to where BP was thinking when they considered purchasing this asset. But I think really the last piece that's important is that investors in renewables are going to increasingly have to pay to play. We don't anticipate that the cost of entry is going to get cheaper as demand for some of these services and these opportunities is just increasing. And so we think it's positive that BP is actually in relatively early in terms of the coming decades, and they can potentially harness cost reductions to meet their long-term objectives. But of course, that's one project. And I think what's really important with these types of developments is understanding the range of possibilities and the range of economic outcomes. And we stress that because with assets that are in their technological cost-cutting phase, but maybe aren't fully optimized, the range of outcomes is in fact pretty wide. And this becomes increasingly pertinent when many developments are marginally economic. And so one assumption here or there could be the difference in whether a decision is made or not. And so what we're showing is we're sensitizing things like capacity and OpEx and energy price to give a sense of really what we're trying to answer here. And that is, what do you have to believe about, in this case, onshore wind, offshore wind, and floating offshore wind, but by extension, solar and other energy streams, for them to be competitive with the spectrum of oil and gas opportunities globally. And you're seeing that on the left-hand side. We're not just looking at shale, we're actually looking at things like offshore platforms, LNG, tiebacks, and the like. Now, admittedly, these IRRs don't have to match for operators to choose wind or other renewables, but these are the debates being had across the energy industry today, and an objective understanding of both opportunity sets is increasingly critical. So that's a preview of how we're approaching these types of questions through the intelligence lens. I'll hand things over now to Nick to show what we're really excited about, and that's the improvements currently being added to our Prism platform, really extricating these types of workflows and these types of questions and placing them in Prism so that clients can do these thought experiments by themselves.
Great, thanks, Oma. And thanks, Philip. Those were both great overviews of some of the work that we've been doing. As mentioned, ultimately, our goal is to put the data analytics that both Oma and Philip highlighted into the platform and give clients the opportunity to ask and answer these questions themselves. What we're doing is we're building a single platform for all energy use cases so that people can be confident and make data-driven decisions. What you're looking at here is our testing environment where we've pulled in all 65,000 active wind turbines in the lower 48 and put them in the platform. So you can see some of the standard header information and other base information like turbine capacity. We also have construction year, location, operator, turbine height, rotor diameter, etc. But what we've also done is layered in analytics, and that allows us to get predictive on things like turbine degradation through time, expectations of different LCOEs today and in the future, and looking at things like returns and different NPV calculations by turbine. So one thing that makes us really excited is that optimizing renewable development is a multivariate problem, much like hydrocarbons, which we've spent the last few decades sorting out some of the most complex challenges with hydrocarbons. We can now apply a lot of that learning to the renewables and alternative space to to push the envelope forwards and to solve some of these challenges. For example, here is a wind farm in the US. We're looking at the actual power generation through time. And then what we've done is we've used some of the learnings on the multivariate models and forecasts that we've built in hydrocarbons and used some of those teachings to help forecast this out into the future. So what we're able to do is calculate an independent view of power production going forwards. We're able to look at different economic parameters, assumptions, and outputs. And really what we're able to do is apply this and utilize it on all 65,000 turbines at once within the platform. And ultimately what we're working towards too is adding in solar fields and other types of alternative generations. Keep in mind, everything you're looking at here is only the V1, but we're iterating fast and we're improving quickly. And the power of the Prism platform is the speed at which we could innovate. Here's an example of ways that we could track real economics through time. What we're looking at is the levelized cost of energy for the wind projects in the lower 48, grouped by year. But anyone could calculate a levelized cost of energy. What we're trying to do and what we're going to focus on is bringing transparency into the space and allowing clients to modify our base case inputs in real time to choose their own adventure. What we found when looking at the space is that things are still relatively opaque. It almost reminds me a little bit of the start of the shale revolution, where there was a lot of numbers being thrown around, but it was hard to do independent analysis to verify some of those numbers. That's what we're doing here. We're independently calculating some of these forecasts and calculating economics to give much more thorough insight and understanding of some of the numbers that are being thrown around. And of course, with everything we do, we're building a platform. We also have our analyst expertise that will provide ongoing conversations with our clients. And really that's the relationship that will allow us to evolve and participate in the energy evolution as partners with some of our clients and some of the people on this call. And ultimately, this stuff that we're doing here, it is extremely hard, but as we've said a couple of times, dealing with the complexities of oil and gas data sets when you're trying to, land a well 10,000 feet below ground and, drill 10,000 feet horizontally while staying within this little pay window. Those are incredibly hard questions too, and our experience there is setting us up well for bringing very deep and thorough analytics and insights into this space. And one thing I do want to touch on just before we go is some other work that we've done and some other data sets that we've pulled together around greenhouse gas emissions and different flaring data sets. What we're doing here is bringing insight again into another opaque part of the business. What's great, like the greenhouse gas emissions are all part of the energy ecosystem, and they're driving the world, and they're all part of the energy ecosystem, and it's becoming more and more important to have a thorough understanding of emissions profiles when making investments. So what we've done is we've gathered a lot of reported emissions data and structured it and cleaned it and scrubbed it and added it to the platform so that it's analytics ready. Here's an example of benchmarking emission intensity across all plays in the US. You're also able to do this through time, look at things on a per operator basis, and look at the data in a few ways. So much like alternatives and renewables, the power that we bring is having the analyst team understand the data and develop real world use cases, which we could then put into the platform. So here's a quick overview of the GHG emissions within the platform. So you could track either regional emissions, you could look at things on a per sector basis, track emissions through time, look at where some of the larger outliers or larger emissions are being sourced from. And with reported data, what's great on the emissions front is that we could also supplement that with satellite information, and we're able to track more real-time certain emissions or flaring data, such as in this case methane. So what you're looking at here is a monthly methane map of emissions data, which we're then able to tag to different wellheads or different facilities, so you can get a much more real-time look at methane emissions. So there's a lot of things here that we showed today. There's a lot of information. We're definitely pretty excited. And to wrap things up, what I really wanted to hit home on is what we're working to do is pull all of the pieces of the puzzle together and put it into one state-of-the-art platform. Our analyst and developer relationships allows us to ensure our work is empirically and theoretically robust. And we're excited for the opportunities that these new data sets bring and allow us to work with our clients, and we look forward to helping our clients as much as possible in the future. So I'd like to wrap that up and thank everyone for their time.